Welcome to Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco, and my dear partner Hari Radhakrishnan. This is episode 19, Cash Flow Statement Part 2. Welcome, everybody. All right, we are on our journey, very close to the end here in terms of our financial statement journey, all the way from income statement. Now we are at the last leg of the journey. We are talking about the last part of the cash flow statements. Congratulations, people. All right, let's dive into this. Okay, in the previous episode, we talked about cash flow statements part 1, and we talked about the first part of cash flow statement, which is cash flow from operating activities. In this episode, we want to talk about the last two bundle. The first bundle we want to talk about is cash flow from investing activity, and the second one we want to talk about is cash flow from financing activities. Those are two distinct buckets that cash flow statement is organized into. Okay, so let's dive into the first part, cash flow from investing activity. Hari, why don't you kind of define that for us, and we can dive into what goes in and out of that bucket.
Yeah, so when we talked about this, remember we had said in the income state or in the cash flow from operating activities, it's a net reconciliation, to get from the income statement to here. So in a lot of ways, the cash flow from investing activities tells you a story related to more on the balance sheet on the non-current asset side, right? And so what you're doing here is you're basically buying and selling things in this cash flow from investing activities to support your operating activities. So, so think about it. When we bought our hot dog stand, we paid for the equipment, the machine to cook things, and we expected those things to last longer than a single year, as opposed to the operating activities, which are, paying our employees, paying for the food, paying for air conditioning, paying for rent, that kind of stuff. So for cash flow from investing activities, what we're doing here is called capital expenditures. Is the top bucket. And that capital expenditures is also called purchase of property, plant, and equipment. And so purchase of property, plant, and equipment, this is probably the most important, thing, and we're going to emphasize this, and we'll tell you why, but in a little while, this is the, metric that we will use to measure how successful a business is in terms of its valuation and how it uses its capital to invest. So inside this purchase of property, plant, and equipment, there is actually two things that are going on here. One is maintenance capital expenditures, which are repairing and fixing what is already what you already own and replacing it. And then there's also growth capital expenditures. So these two buckets are very important, and what we really want for our valuation calculation is actually the maintenance capital expenditures, because that tells us how much does it actually take to maintain the business as it is. Growth is a great thing, if it's profitable growth, but we want to know how much it takes to maintain the business, and then we can see how much money they're spending to grow the business. So we want to keep those separate, and some companies are very good about making that line in the sand so that you can see it. Others aren't necessarily so. So the other thing is you can buy property, plant, and equipment. You can also sell it. So let's say that you had a store that you just wasn't selling, doing as well as you wanted to. You can sell off, obviously you can take the goods and move it to a new store, or you can sell them off for cash. And that would also be recorded in this section. So you're essentially moving your money in and out of things that are non-current assets or longer-term assets, and that's all what you would see in this section.
Yeah, I want to reiterate non-current asset and kind of go back to our episode where we talked about balance sheet, right? Non-current asset. If you remember the asset part of our conversation here at this podcast, we talked about current asset and non-current asset. Non-current assets are assets that the company is not intending to liquidate within a year.
Yeah.
So that includes, under that bucket, obviously that includes that includes property, plant, and equipment. These are things that you're not going to liquidate and make it into cash within a matter of a year.
Right.
Because it's so integral to the company itself.
Yeah.
And so I just wanted to reiterate the definition of non-current asset.
Yeah, and I think the other thing there, just to make sure that we're also clear, is sometimes companies will report this as net property, plant, and equipment, purchase of property, plant, and equipment. And what they mean by that is, let's say we bought a truck, like we have a food truck. We bought a new food truck and we sold the food truck. They may just report the difference of the price of the purchase price and the sale price here. And so that, what you're actually seeing is is offsetting these numbers. So when you look at these things, what you really want to be paying attention to is depreciation and amortization. We had talked about earlier. Depreciation specifically is an expense on the income statement. And, it ties to, the measurement of how, an asset that you own wears out. So, if we bought all our stuff is very new, we may not have a lot of purchase of property, plant, and equipment in year 2 because it's all new and it's still shiny and it still works great. But we still take that expense on the income statement, and our cash flow looks like we're making more money. And then in year 5, when all of that equipment just falls apart, now we have to make this big outlay of purchase of, to purchase all new equipment. And so what you really want to see in a business like this, and as a business grows, that number kind of averages out, they're basically offsetting all of the cost year over year. Some businesses have a much larger investment into purchasing, equipment than other businesses.
Yeah, it's just the nature of the business.
It's the nature of the business. And so think about let's say we're running a U-Haul business, right? Or we're running a construction company that rents out equipment. That equipment depreciates very fast because we're renting out to people, they use it, and it's getting constant heavy use. And so we may be able to depreciate that asset over a 5-year period, but it actually may have a very useful life of 2 or 3 years. And so what ends up happening is on the depreciation expense is actually lower than the purchase of property and equipment. And in many cases, it's the opposite. But, it's very important to pay attention to this because we're talking specifically about maintenance expense, capital expenditures. Mm-hmm. Over the long term, the depreciation and purchase of property, plant, and equipment for maintenance should equal each other out. If you're seeing one spend in another area, that can really affect your, that maybe the company is actually juicing short-term profits by under investing in the business, and then eventually things just kind of run out. Sears is actually a fantastic example of this. So Eddie Lampert, who owned Sears through his hedge fund company, was the largest shareholder, and then became the CEO. He refused to update the interior of Sears. So he'd replace the carpet, but not really spruce up the inside, and so a lot of people didn't want to shop at Sears because of that. Now his argument, and I don't know Sears well enough to say this, is he wasn't seeing a return on his investment when he invested money into the stores, and so that this is why you also need to read the footnotes with these financial statements, is to say, hey, we're not spending as much money in PP&E or CapEx. And why is that? And, sometimes businesses say, hey, we had record profits, but we also aren't investing in the future because we're just trying to squeeze more out of our existing asset base. So, it's important to pay attention to this because this affects valuation. It affects how the long-term nature of the business, and you really want to look at this very closely and make sure that they're maintaining the level of investment in the business, to support their existing sales.
Yeah, and then you talked about the nature of the business that makes this a important variable for some and not important variables for others, right?
Yeah.
So maybe you can give so you talked about Sears, you talked about a construction company U-Haul as examples of companies that maintenance CapEx is very important, and potentially for growth CapEx as well.
Right.
Can you tell us maybe a counterexample of a company that this is not so much a big issue? So
yeah, so tech companies actually are the prototypical example of that. So they're asset light businesses. So their investments are into technology, so research and development and people, right? And not so much investments into assets. They're not buying a lot of physical goods to replace, to make that. I mean, every one of these does have physical assets, like Google has servers, and Microsoft has their Azure cloud that they run, and same with Amazon. And it's an interesting thing that you would look at is, they do have assets, and in the past, asset light businesses were a lot less common. Nowadays, they're becoming more and more common. So you see a lot of people have kind of just treated every business as if it were an asset light business, and that's why you see a lot of this people using these metrics like EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And you can't use that in a asset heavy business because depreciation is a real expense, and it always is a real expense. Yeah. Interestingly, a lot of people look at companies like tech companies and say, well, they're a tech company, they don't have it. But if you have servers actually depreciate very, very fast. And so when they depreciate, you have you have to continually buy to maintain your server farm. And so, and maybe you can get a good deal. I think from what I've heard, and I don't know this, with, any degree of certainty, Amazon doesn't buy the latest and greatest, servers to put into their EC2, to their cloud platform. They buy slightly older models so that they can get, and they have a very rigid, we standardize on one server type, and that allows them to get the best bang for their buck in terms of depreciation and amortization. Whereas if they were buying a higher end CPU, much more expensive, but its shelf life would, depreciation would eliminate it really quickly. I mean, think about it the same way like you have a $100,000 Mercedes versus a $30,000 or $20,000 Toyota Corolla. The amount of depreciation in that Toyota Corolla relative to the Mercedes, they both depreciate over the same lifespan. But you would be taking a $10,000 expense on Mercedes and if it was a 10-year lifespan, and a $2,000 expense on the Corolla. So there's a lot to think about there when you start really breaking it down. Property, plant, and equipment is a really important concept here. And that's why we want to emphasize. That's why we've only been talking about it the whole time. So,
yeah. Okay. So that is a very important part of the investing activities. We talked about the maintenance CapEx. We talked about growth CapEx. Do you want to talk about why don't we talk about the inflow of cash? Now we talked about the outflow of cash, right?
Yeah.
The maintenance CapEx, growth CapEx, these are all expenditures out of your bank to someone else's pocket because in exchange you're getting, equipment or what have you. Now, what about the other way around? What is cash coming in that is accounted here in cash flow from investing activities bucket?
So let's say that our hot dog stand had the brilliant idea of we also wanted to run a pawnbroker. So,
brilliant idea.
Becco woke up one day and he's like, you know what? Hot dogs are awesome, but I want to be a pawnbroker. I want to appear on Pawn Stars. So one of the interesting things about financing is also businesses can actually make loans, right? And so I actually owned a pawn company for a for several years, and I did extremely well with it.
Owning by that he means like owning a stock.
Correct.
In a company.
Yeah, publicly traded one.
Not that he's running one.
No, can't you see me with running a pawn store? So, what's interesting about the pawn brokerage is that they make loans, these micro loans where they take your asset and then give you a collateralized loan, basically. So I have a camera that I no longer need, or I'm willing to pay for it, but you give me $100 for it, and then I'll come back and pay it off in the next 30 days or 60 days or however long you want to use it. Mm-hmm. And so what they do is they'll actually transact that in this cash flow from financing activities. And so cash flow from investing activities. So they will actually make a loan, and when they collect on that loan, that actually appears here in this. So in that section, you are making loans, and there's obviously a net component to this. So outlaying and receiving, I'm paying out money to loaning money to somebody, and then when they pay it back, that's all indicated here. So that's one component of this. The other component, which is also something that we will talk a lot about, is companies have the ability to buy back shares in their own company, right? And so when they buy or distribute, so as we talked about in the debt and equity, we distributed shares to people in our group, our family and friends, who then paid us cash. That cash shows up in this cash flow from investing activities, and that's how we indicate it, that it was an inflow into the business. And then that also increases our balance sheet, the cash on the balance sheet. But this is how we record what period that money came in. Because remember, as we've kind of drifted away from the thing, this is cash flow statements are all based on a period, whether it's a quarter or a year, whereas the balance sheet is that snapshot in time.
Yeah. So that's money coming into your bank account, right?
Yeah.
And Hari said we can loan out, we can issue debt, and when you issue debt, people give us the money, and same with the equity side. We can sell ownership stake in our company, and in return we get cash, and that's booked here inside investing activities, inflow of cash. And then on the outflow, we talked about CapEx, which is money, like I said, money going out in exchange for server or what have you, a truck. But then you can also get money out with purchase of debt instrument or equity instruments.
Yep.
So do you want to talk about that a little bit more?
Yeah. So now we're in the cash flow from financing activities, right? And so cash flow from financing is, we talked about debt and equity, and in that debt and equity section, we are really talking about I'm issuing debt to the bank or from the bank. So the bank gives me a loan. I have to pay off that loan. The money coming in is added to my cash on the balance sheet, and it also shows up as a positive on the financing activities. In the cash flow from financing activities. So that's where we can see money coming in. So if you imagine a business that's losing money, that has to borrow, because they're promising growth in the future, like think of a biotech company that has no money. Actually, biotech companies have to issue equity, but because banks, they don't have an asset to loan off of. But think of a company like Uber that is, is offering bonds. Corporate bonds to generate cash. You would record that in the cash flow from financing activities. And this also includes other things where cash gets converted to the business. Like some companies will issue options that or warrants that will allow them to sell equity in the future. And in that, there's a debt component to that, and that appears here in the cash flow from financing activities. The other side of the ledger here is companies will also pay out dividends, and that dividend is also coming out of this financing activities section. So when you pay out a dividend, Obviously it decreases your cash balance sheet. It also decreases your retained earnings, which we had talked about on the balance sheet, and it decreases your it's a negative on the cash flow from financing activities. So sometimes companies also receive dividends because they own debt in another company. Depending on how that's structured, it may appear here or it may appear in the investing activities.
Yeah. So can you so the line between investing activities and financing activities can kind of blur, like you said there.
Right.
So can you maybe go through the differences with our listeners so that we understand that even though it may be great, but there's a clear distinction between investing activities and financing activities?
Yeah, if you're loaning money, right, like in our pawn shop business, that's an investment because you're loaning the money to someone. Whereas if you're issuing debt, which is really, I'm asking somebody to give me cash, and then I have to pay that off. That's really more of a financial thing. Yeah. So I mean, like you said, it's kind of it's not a hard and fast rule, and there probably is a rule of thumb that defines that. For the most part, I when I look at these things, what I'm looking for in the investing activities and the financing activities is really more focused on the investing side. I'm looking at the purchase of property, plant, and equipment, and I'm looking for, is the company raising money or buying back shares? And then when I look at the financing activities, ideally what I want to see there is that, there is limited debt that the company has, managing, because, debt can get very complicated, and some companies have a lot of debt. And, we've had for the last 10 years very low interest rates. So a lot of companies have said, well, the cost of that debt is so low, I'll go and take it on. But you still do have to pay it off. And, companies will go take that cash and then go do something dumb with it. Mm-hmm. And then now they have no real way of paying it off. Mm-hmm. And so they have to fight their creditors and restructure their companies and things like that. And that's when companies get into trouble. So I try and stay away from those things. But this is kind of where you can see how much money are they having to pay every year, to service their debt. How is that affecting their cash flow? And then you can kind of pay attention to that here.
Yeah. So I just wanted to recap that really quick because it can get really kind of confusing here. And I think as you were listening to this episode, you were probably thinking the same, I imagine. So I just want to quickly summarize. We can get into the details of this, but as investors, there are things that you need to really understand, and other things, maybe not so much. And so, to reiterate Hari's point, in the investing activities section, what you're really looking for is the maintenance CapEx and growth CapEx. So these are, this is something that you really need to understand if you want to follow the business closely. And then also the share buybacks is also counted here in the investing activities. So those two things are what you need to look for in investing activities. In the financing activities, what you're looking for in this section is payment of dividend as well as the debt payment. So this is the financial health of the company as well as how much the company is handing out to its shareholders. So obviously we talked about a lot more than what I just summarized here, but those two concepts, investing activities and financing activities, those two things are really paramount to understand. If you don't, that should be the takeaway of this. Of this episode.
And I think when we, the next couple of episodes, we're going to really hammer a lot of these things together, bring all of the financial statements together so you can see how they kind of fit. And then it'll become a lot more clear. And the other thing that we're going to do is kind of define a lot of the metrics that we use as investors. Some are more valuable than others. And using those metrics, you get them from these various statements. So that'll help you kind of identify what are the important areas, what are the less important areas, and then so that when you start reading these annual reports for yourself and looking at financial statements, you'll know what you're actually looking at.
Right. And then moreover, as we progress with our episode count, we will actually start analyzing companies. And when you do that, with understanding of different financial statements, it'll click more. Because right now we're just talking about abstract ideas. It may seem like an abstract ideas without hard, concrete numbers, but when we actually start cracking open 10Ks and reading financial statements with you guys in this episode, which we're planning to do, it might click better. So if you're lost, don't worry. We will help you along the way. And yeah, so that was the cash flow from investing activities and financing activities. Anything you want to add here before we close it out in this episode, Nori?
No, I think we'll just remember to pay attention to the difference between maintenance and growth CapEx. I think is very important, and when we start talking about what's called free cash flow, we're gonna look at that number very closely.
Yep. Okay, thank you everybody for joining us. This was episode 19. Wow, 19. Very close to 20. Man. Okay, we're moving ahead. Thank you guys for joining, and if you liked the episode, please do subscribe and tell your friends about our episode. We are moving ahead, and I hope these episodes are helpful. Please leave us some feedback on the comment section or email us directly at info@valueinvestor.org. Okay, I'll see you guys on the next episode. Thank you.
Thanks.